Hey everybody, this is Sean Leland with NEXA Mortgage. This week on The Ripple Effect, we're breaking down why mortgage rates felt unstable, even though the weekly averages barely moved. If you zoom out, rates didn't really trend higher or lower this week. They mostly went sideways. But if you were watching day to day, they moved around a lot. That's because the bond market was choppy. Here's the grounding point. The average 30-year fixed mortgage rate only moved a few basis points on the week. So on paper, not much changed, but mortgage rates aren't set by weekly averages. They're set by daily bond trading. And this week, the 10-year Treasury moved sharply early on, then settled back down later in the week. When bonds sold off early, yields went higher. That pushed rate sheets worse. When buyers stepped back into Treasuries after solid auction demand, rates stabilized. Now let's talk about the data that mattered. Inflation continued to cool, but slowly. December CPI didn't surprise the market, and core inflation didn't move higher. That's constructive, but it wasn't soft enough to change the rate narrative on its own. At the same time, the labor market is still holding together. Jobless claims stayed low, so there was no clear signal that the economy is breaking. And in housing, we're seeing something important. Even small rate dips are pulling demand forward. Mortgage applications jumped last week, with refinances reacting the fastest. So where did expectations miss? A lot of people expected good inflation data to automatically mean lower rates. But rates don't just price inflation. They also price growth, Treasury supply, and risk sentiment. And right now, we're heading into a Fed meeting with no new guidance. That puts the focus back on bonds, not headlines. This is the ripple effect in action. The Fed influences the front end. Treasuries move on data and supply, mortgage-backed securities follow treasuries, and mortgage rates are the final stop. So here's the takeaway this week. Rates aren't in a clean uptrend or downtrend. They're range-bound and sensitive. That means timing matters more than direction right now. My confidence level here is medium. Inflation is cooling gradually. The labor market is steady, but daily volatility is still coming from the bond market. If you want help thinking through a lock versus float decision around your specific timeline, DM me READY or text 509-463-5122. And if you're a first-time buyer and want a clear walkthrough of the process, check out homecoachhq.com, a step-by-step video series designed to help you prepare confidently with a $500 appraisal gift card when you're ready to move forward.